Paul Schatz is still with us. He's president of Heritage Capital. Paul, we earlier talked to Brian Lynch, who focuses on just pre-IPO companies. That's what her investment platform does. And I asked her, what is the seemingly indiscriminate buying of all of these IPOs and other types of public listings, SPACs and direct listings this year? What does that tell you? I've been talking about the phrase thirsty cash lately, that people just want to throw their money somewhere.
This almost feels like the next gen .com bubble. So before I get all the ads, how wrong I am because the companies actually have revenue, I get it. That's why it's next gen. But you only get this kind of landscape when you have full on greed and euphoria. And it takes so many different, it's a perfect storm, frankly. So you've got obviously zero interest rates. Nobody cares about that. No one's going to the bond market right now. And you've got a market that completely collapsed in the first quarter and now is partying like it's 1999. So it's really enticing so many people who have been sitting and waiting and waiting and waiting. Look, after the Corona crash, so many people, look at cash levels were almost at all-time highs in a short period of time. And so many people couldn't parse how the data and the markets were diverging. And now they're going all in because you've got new stocks coming out. This whole SPAC wave is replacing private equity, supposedly. But you have again, this perfect storm of liquidity and of greed and euphoria. And that's why everyone's just going all in.
Paul, that optimistic mood for me just completely went away when you're talking about some of these IPOs. Which, in your view, which company, DoorDash or Airbnb, which company do you hate more and why? Which business model do you think really stinks?
Well, I'm glad we're coming at it from the negative side. So if you gun to my head about it, I would take Airbnb over DoorDash, probably because DoorDash has some pretty stiff competition right now in Uber and the likes, and Airbnb not as much so, but competition will increase over time. Listen, as I said to you during the break, I wouldn't touch either one with a 10-foot pole. I wouldn't buy it with your money, Julie's money, and Adam Shapiro's money. So my view on the hot IPOs, and I listen, 32 years doing this, I've been wrong, but my view on the hot IPOs is you do nothing out of the gate. Unless you've got friends and family shares, you sit back and you watch, and there's a 3 to 6 month period where the vast majority, I'll do a newsletter on this shortly because I do it for every hot IPO, and I publish all the charts of previous hot IPOs, and the vast majority have that initial kick, and they spend 3 to 6 months in volatile territory, but on balance going significantly lower. And I think if you love Airbnb or you loved Uber, I said same thing to Uber and Lyft and Square and Alibaba. You sit back and wait. Every once in a blue moon, you'll get a Google, which doesn't have that 3 to 6 month decline. And I'll be wrong, frankly, but most of the time it pulls back. I don't love feeding into the euphoria. I'd rather be a seller of stock. There's an old expression on Wall Street, when the ducks quack, feed them. And Wall Street is certainly feeding the ducks right now.
I mean, if you bought Google 3 to 6 months in, you're still doing pretty all right. Even if you waited and the dip didn't happen and you still bought. We were talking during the break, Paul, about, okay, so you're not looking at these hot IPOs. What are you looking at right now with valuations where they are? Do you see entry points for anything? Maybe maybe travels. You were talking about traveling earlier. Maybe travel stocks.
Julie, it is really hard. Every day I come in and I look for opportunities. That's my job, and I love what we own. I love what we have. I'm finding hard to spot opportunities that check all my boxes because frankly, my personality and the way I run money is I won't buy something that's melted higher, even though I think it's going higher. It's just not what I do. So I have to find companies and sectors and ETFs that are checking all my boxes. It's been really difficult, and I'm not going to change what I remember. The same thing happened in the .com bubble. Now, it's a little better. We've got a more broad-based rally. So things like, GWPH in the cannabis field, that's a real nutraceutical company. I think that one could have a takeover behind it at some point. And I think that could have legs to it, and it's pulled back. I'm looking for stuff. We bought Las Vegas Sands a week or two ago on a play on that Macau is going to return. That's the for me, the best plant for Macau. But again, it's hard to find things that fit in your little bucket. Zillow was one this week that had consolidated and has a nice tailwind behind it. And DraftKings had a beautiful pullback that we bought twice. But I'm really cherry picking and pulling things that are outside the norm. It's more difficult. You have to almost close your eyes. And if you have to put money in, drip it in. I would not use these kind of markets to go all in. I think that's when the latecomers get punished harshly when the market reverses, like it did in January of 2018. Very similar market that pulled back 13% in a couple of weeks.
Paul Schatz, Heritage Capital President, thank you so much, as always, for giving us some insight into how you think through the market. Appreciate it.